What's up, everybody, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. I am your host, Cody Laughlin, and with me, as always, is my co-host, Mr. John Beatty. And we have a very special podcast guest for you today. But before we get to the show, make sure to jump over to Apple Podcasts, Google Podcasts, and Spotify and download today's episode. And make sure to leave us a quick rating and review. We really appreciate your feedback and help getting the show out there. Also, if we haven't connected with you yet, we would love to do so on social media. You can check us out on Facebook, LinkedIn, and you can follow us on Instagram. And if you'd like to learn more about me and John and how you could potentially partner with us at Blue Oak Capital, check us out at www.blueoakinvest.com. So with that, to the show, John, who are we speaking with today?
All right. I am excited because Neal Bawa is in the house. For those of you who don't know Neal, he is the mad scientist of multifamily, better known as that. So he's got a large multi-million-dollar portfolio in multifamily, and actually is also expanding in some other verticals. But the mad scientist, Neal, lives by two mantras. We can only manage what we measure, and data beats gut feel by a million miles. So Neal is a data guru. And that's what he does, and he puts this into practice. He's the CEO and founder at Grow Capitus. So it's a commercial real estate investment company. They've got a 28-person team, multifamily and commercial projects across the U.S., tons of investors, very successful. And in addition, he's also educating other people through, he serves as CEO at Multifamily U. And I'm actually a former student in some of his boot camps, but that's an apartment investing education company. He's had over 5,000 attendees at these boot camps. And honestly, go to multifamilyu.com. There's plenty of great content there if you want to check it out. It's amazing. He provides a ton of value all the time. Neal, thank you for coming on the show.
Thanks so much for having me. It's actually thrilling to be on a podcast that's being hosted by one of our students, because I think that you have a great understanding of our philosophy and what it is that we truly care about. Thanks for having me.
Absolutely, man. We're honored to have you on the show, and definitely looking forward to picking your brain. You know, the mad scientist. It's we love that phrase, and kind of tell us a little bit more how you came to be coined the mad scientist, if you will.
I think it's because I'm constantly experimenting, and I think it's also because I don't have a filter. So I tend to just say stuff, and people like that. I mean, and a lot of that comes from technology. So I'll give you guys an idea of just how different, like, high-tech core technology, people that are developers or programmers are. I once went to a Microsoft event. And the event was, there were 5,000 developers in the room, right? And I'm kind of in the front, and they're basically they introduced this speaker, and apparently he was some big deal. And this guy basically shows up on stage. He's wearing a T-shirt with torn, basically shorts, and he goes and looks at all of us, and he's like, "What's up, motherfuckers?" And that's the start of this conference, right? He is the keynote speaker, and he goes on to deliver this magnificent keynote, right? And then what was funny was to see the actual response to the audience, right? So the 70 or 80% of them were core developers, and they're just laugh it off. And the other 20% are really shocked by it. It's like, how could someone start a Microsoft conference with 5,000 people with a 4-letter word like that? And then they look around and realize nobody else gives a damn, and then they adjust to it, right? And by the end of the conference, everyone's just so loose. People just say what comes to their minds. And so if you are part of that culture, you tend not to have a filter. You just say stuff when it comes to your mind. You're not thinking, well, this big dog was saying the exact reverse of what I'm talking about. It's like, I don't give a shit, right? This is the way I see it, and either I'm right or I'm wrong. There's only two options, and I'm okay with both of those. And I think that has given me that mad scientist moniker. I'm not really sure who came up with that, but it sort of started to circulate in social media, and eventually I was like, this does describe me well. So I'm gonna go with it. I'm gonna be okay with that. And so now we mention it in all of our media kits and as well, and we're happy with that. So a lot of it is about experimentation. I'm constantly experimenting. And what's funny is my most popular experimentation video is not about multifamily, but it's all about multifamily. It's about how I grow tomatoes and how I use raised beds And it talks about all the different experiments that I did. Is it LED lighting? Is it soil? Is it aeration? And how deep does the soil have to be to get the perfect size tomato? Because I don't want it to be too deep, because I want, raised beds, because I hate bending. And so this video kind of goes into the details of all of that stuff, and what colors of LED lighting actually worked and what matters the most, all of that stuff. And then at the end, it's like, okay, but this is how I actually make $500,000 a year. I raise $500,000 a year by using this. And the key was the lights. I keep them on 24 hours a day. And so there's this alien pink and blue glow in the back of my house. And I live in a rather affluent area. There are all these $1 million houses. And so people walk in the evening, and my house is a corner house. So they walk past my house and they see this blue and pink alien glow. So eventually, over time, curious people kind of look over the fence to see what the heck is this glow, and they realize this guy has a farm. He's got a tomato farm, and then they see all the tomatoes. And so as the tomatoes are growing, people are kind of watching them as they go by. And then in the middle of summer, I'll take a bag of tomatoes over to their house and start having a conversation with them about it. And that conversation leads to lots of investments, right? Because by that time, they're already nurtured because they've been looking at it for months. It's not new to them, right? So I don't actually take my tomatoes and use them in the kitchen. I take my tomatoes and I distribute them to people. And they're like, oh, yeah, you're the guy with the weird lights. Yeah, I remember you. And then that conversation ends up with them becoming multifamily investors.
That's great.
That's fantastic. I've heard you speak several times, Neal, and I've watched a lot of your stuff. I have never heard that story. I love it.
That's my favorite, right? Truly mad to be doing stuff like that.
I love it, man. It's fantastic. So, well, part of your reputation, obviously, for what most people know you is, your detail to data and how do you follow data and track that. And so that's actually what I was kind of hoping to spend a little bit of time with you today and talking about, and particularly looking at, some of the trends that we have seen over the past 5 months during the pandemic. And again, I just watched one of your webinars here recently, and it always very informative. Absolutely love the content that you put out there. But I was hoping that we could pick out some of those topics and really just kind of cover some of that for those who may have not had the opportunity to watch that yet. But and again, I want to kind of start off with, what are some of the surprising trends that you've noticed over the past 5 months during this pandemic, in particularly in the commercial real estate space?
I have to say the number one, there've been two surprises for me. I wasn't as surprised about multifamily doing okay, because I've always felt that when people have money, the first thing that they will pay for is food, and the second thing they'll pay is rent, right? So that's been one of my core beliefs for a very long time. It was proven correct because we had this huge, increase in unemployment from, went all the way up to 13, 14%. We didn't really see much of a drop in rents. I mean, it's been pretty decent for the last 4 months. And that's because people have been getting unemployment checks, and basically they're going towards food and they're going towards rent. So that was pretty predictable. A lot of people said gloom and doom, and I wasn't really buying it, because it's like, well, this is a supported economy at this point in time. So that was not a surprise. The two surprises have been, I predicted that student housing would do really poorly, and I clearly turned out to be wrong. And so I started to dig into that, and I said, well, clearly wrong, but why? Why was I wrong? Because I felt like, wait a minute, students would be up in arms and demanding money back from the student housing operator, saying, hey, we can't live there, and we shouldn't be paying for this, give us a refund. And next year I expected the enrollment levels to be very low, and they weren't. The enrollment levels for student housing today at a national level are in line with where they were a year ago. They look the same, right? Nothing's changed. Now, there are individual universities doing poorly, and then there are universities, shockingly, like in California, that are online-only universities that have the same, better enrollment trends than last year. And you're like, but wait, this makes no sense. I mean, me being the mad scientist, like, oh, what the heck is going on here? This is an online university. They're not really opening anything, but their enrollment is up from where it was last year at the same time. How could that even be? And basically the answer, again, it turned out sometimes the answer is really simple. You just sort of ignore it. The answer was, if the last 4 months, students have been fed up with parents, and parents have been fed up with students, right? Everybody wants separation, And so what it turned out, the students had a very, very strong desire to come back to school, even if that school was online only. It's like, I'm going to just go to the dorm. And by the way, UC is not letting me, even if I'm a freshman, they're not opening their dorms because they don't want the teachers infected. So they're saying, our dorms are closed. Well, guess what's open? Student housing, commercial properties are open, right? So as a result, they actually didn't see a dip. I mean, they didn't see an increase, so it's not a boom time for them or anything. I'm sure they're suffering. But overall, they're where they were. So that was the first big surprise. I couldn't have seen that coming, right? But it happened. And what's amazing is the parents are so fed up with the kids that they're like, yeah, I'll pay you. Just go, right? I'd pay for your tuition. I know you're going to sit in the dorm and take online education, but please leave the house now. So that was the kind of the first surprise that I saw there. The second one, which I think in some ways was a bigger surprise, was the storage industry, right? So storage is known to be a recession-resistant class. Public storage is known to be recession-resistant. There's all this great data about it doing really well. In 2008, I have a storage facility myself, and I bought it because I felt like a recession was coming, and I wanted to get into a recession-resistant class. So I felt like storage would do really well in most recessions. But it turned out not in this one. And so I started to dig into that, and I said, that doesn't make sense. I mean, storage is recognized for its recession-resistant components. And what it turned out is this isn't a normal recession. What this recession did that no other recession in history had done was not only did it take the people that were unemployed and put them at home. Previous recessions, maybe the unemployment rate was 8%, 9%, 10%, right? Well, here, 100% of Americans were forced to be at home, even the ones that were employed, right? And when these people were at home, they had plenty of time all of a sudden because, work was getting done over Zoom and, some offices were just closed. And so people basically had time to go clean out that storage unit that they've had for the last 5 years. That's just been sitting there, and they've never really shut it down because it was only $50 a month or $60 a month. So from a pure nuisance perspective, it was too much of a nuisance to go in there and shut that thing down.
So we had a national spring cleaning.
We had a national spring cleaning. Thank you, John. You said it exactly. I'm going to steal that. That's what I'm going to lead with in the next podcast. Okay. We had a national spring cleaning where people went out and cleaned all these units out because they had nothing better to do, right? They'd already cleaned their house 6 times over. And it's like, okay, well, I need to go do something. Oh, let me go finally get that, boat out of there. And I think that's what caused storage occupancy to fall. And then it really caused prices to fall. And this is a very short-term thing. I'm warning you that I have very little data on this, only like a month or two, and things might change. But when I'm looking at storage pricing pre-COVID, especially at the beginning of this year, and I'm looking at it now, there's definitely a 20% decline. And in some places, there appears to be a 30 to 40% decline, right? So again, that's not everywhere. But I can see that prices have fallen by 20%. And I don't know if they're going to stay here. I don't know if this is the new normal. I know that a lot of storage facilities were being built throughout the U.S. Storage is much easier, much quicker to build than multifamily, right? So, because you're not occupying it. So you can, it's just tilt up walls, right? You can build them very fast. So there was a huge amount of storage inventory. Almost 8% of current storage inventory was being built. That's a lot. In multifamily, you usually get 3%, 4% being built every year. 8%, 9% was a lot. And now it appears that a lot of those lenders are pulling back. They're like, no, we're not going to finish this. We're going to stop your draws. We don't think this is going to work. We don't think that you're going to be able to make the dollar numbers work. Prices are falling. Rents are falling. So I think that when I speak to people in the industry, and I've spoken to many of them in the last 2 months or so, they believe that there's a tsunami of possible defaults coming in the storage space, especially new construction storage space in Q1 and Q2. So that's been surprising for me because it's just one of those things. You get schooled on a concept. Everybody says storage is recession resistant, so you start thinking it's recession resistant and you start repeating it. I've done that. I've been guilty of that. And now I'm kind of trying to fix my mistake saying, I don't think storage was COVID resistant. I think it was regular recession resistant. So those have been the two surprises so far. Multifamily, not so much of a surprise, to be honest. I mean, one of the things that I felt good about, that I felt I was right on, was that in March, people were saying multifamily cap rates are going to go up. And I said, how could they possibly be going up? We just put in $4 trillion into the US economy. Cap rates don't go up when you print money, they go down, right? I mean, we've seen that for the last 8 years. We print money, cap rates go down. It's pretty predictable. And I'm not saying that cap rates are going to go down today. I think that inevitably they have to, because all this money is looking for yield. Money, when you print $4 trillion, you don't create money from thin air. That's a myth. You loan money into existence. Money is always loaned into existence, even by the Fed, right? So whether it's politicians or Fed, politicians simply print bonds and somebody takes those bonds. That's the act of, basically the government loaning money, right? And when you loan trillions of brand new dollars, that creates a search for yield. And that search for yield tends to drop cap rates for every kind of asset, risk asset out there, not just real estate, but it's going to drop cap rates for anything that is income producing. Obviously we saw what happened with the stock market, right? Just down and then very sharply back up. So to me, I always felt very strongly that cap rates is just going to sit there and do nothing. And that's what we've seen so far. They've sat there and done nothing. And then people are like, but if the cap rates are not changing, then prices are not going to go down. And that's what I really want to talk about, because I feel like people don't understand that prices must drop and drop a lot. And that has nothing to do with cap rates. So stop talking about cap rates and start talking about NOI, because that's where all of the drop is.
Fantastic point. That's such a great point. And one that I think that we need to go in a little further, because I think it needs explanation, if you wouldn't mind. So talk to us a little bit about why do you feel we're going to see this drop in the NOI, and how's that going to impact our evaluations?
Sure. So when anyone in the US buys a multifamily, the price that they're paying, that price only has two components. You take the prevailing cap rate of the market, you multiply it by the net operating income, and you get a price, right? So if it's a 10 cap market and you have, a $5 million, asset, you have a $500,000 NOI, then it's a $5 million asset, and so on and so forth, right? So it's very straightforward. Of course, it takes a little bit of time to understand the market cap rate, but hey, you guys are underwriting every day. Eventually, you know what the market cap rate is in a certain market, what should be paid. So the net operating income component of that, there's people already saying, well, if the prices were going to drop, they would have dropped in the last 4 months. Last 4 months were the worst of COVID. Now the economy is reopened. No, how could that possibly be? When we do net operating income, we look at a single document. It's called a T12, right? So it's the trailing 12 months of rent. Now, if today I look at a property comes to market today, right? Its T12 is going to be last July through this June. And so in that T12, there are only going to be 3 impacted months: April, May, and June. So it's going to have 9 stellar months and 3 bad months, right? So the price that you're going to calculate is going to be based on that 3 bad months and 9 stellar months. Well, so you're going to end up paying almost what you were paying in Feb, right? Because there's only a small decline. Now, granted, you're probably going to underwrite negative, rents and those sorts of things and do it based on that. But the sellers haven't adjusted to that mentally yet. Why? Because as far as the seller is concerned, his T12 looks really good, right? Only looks bad in the last 3 months.
And those 3 months were supported by fiscal policy.
Those 3 months were also supported by fiscal policy, right? And it could have been a lot worse. But even with the support of fiscal policy, those months don't look as good as most people think. Because the problem is everyone's watching podcasts, and the podcasts are saying, well, occupancy for Class B and Class C only went down like 0.5%. 0.5% means nothing, right? What they really should be saying is net operating income in the US for Class B and Class C properties since April appears to be down between 10 and 30%. Because what most people don't realize is, if you think about multifamily, all of your profit is between the 85% and the 95% occupancy. And when I say occupancy, I don't mean physical occupancy. I mean people who pay, I mean economic occupancy, right? So all of your profit is between that 85 and 95. So even before the pandemic, the economic occupancy was in the 92% range for the US, right? Physical occupancy 95, economic 92. That's where we were. Now let's say it drops from 92 down to 89, okay? A lot of people are like, that's a 3% drop. No, it's not, because all of your profit was really from 80 onwards or 85 onwards. And so when you drop 3% from 92 to 89, your income's dropped 20%. Your income's dropped 30%. And so far, it's only dropped 20 or 30% for 3 months. But a month from now, it's going to be 20 to 30% for 4 months. And 6 months from now, it's going to be 20 to 30% for 9 or 10 months. So each month that goes on, the price of multifamily is automatically dropping. No one has to do anything to drop it. It's going to drop by itself, because as long as you use the same Excel spreadsheet that you were using in Feb, it's going to show lower numbers. Mm-hmm. And because everyone's numbers are going to be lower, because they're all based on the same T12, sellers are going to be forced to accept it. Therefore, the price of multifamily must drop, and must drop substantially, and will continue to drop, in my opinion, until next April, because you need to have 12 months, right? And when do you get 12 months of post-COVID? You get 12 months when a property comes to comes to market next April, maybe next May. So how can they stop dropping before next May? Anybody who says that simply doesn't understand math.
So 12 months from April, start of COVID. Right?
Yeah, I mean, in my mind, the best deals are probably going to be next March, because the market does look into the future. So if, let's say we get a vaccine in Jan, that gives us a consumer sentiment boost in Feb. That means that March is a really good leasing month. So then somebody that's selling the property in April is going to point to the fact that the market is now doing better and expect a higher price. So I think that the best prices may be like in this, if you're locking in deals in Jan or Feb or March, that's when you might find the best price, because you can say, hey, look at your T12, it's pretty bad, and the market looks pretty bad too. So I can't give you a future boost because the market looks bad. But I think by the time we get out of Q1 and get into Q2 next year, the market's going to start looking better, because either you're going to have a vaccine, or you'll be vaccinated, or you'll have good news about a vaccine. Either way, you're going to expect that future boost, and you have to put that into the price. So I think that if you buy in Q1, that's probably the lowest price that you'll get. That's my feeling. Now, unless something else blows up that's COVID related. I mean, and that could happen, right? So one of the things that I've been talking about, and we can talk about this more, I'll just say it and finish. I think we are in a black swan event that will cause other black swan events. And if you ask me what they are, I'm going to say they're black swans. How could I possibly know? By their very definition, I couldn't know. I can speculate, but I'm probably going to be off by a million miles, right? So I can speculate on that. So if there is a follow-up black swan event, then all of these numbers could be wrong. But if they're wrong, they're only wrong insofar that the price of multifamily keeps dropping, doesn't stop dropping. Mm-hmm. But I think the initial drop is guaranteed. And so when people say it's not going to drop, they have no clue what they're talking about.
Yeah, I like to remind people, look, every Thursday, wake up at 7:30, check out the jobs numbers. Initial claims continue to kick up a little bit, 1.6 million. Continuing claims is still, 16, 17 million, which is actually increased week over week. And
it's bizarre that we say those numbers and don't shake our heads, because that is stunningly large numbers, right? We should be talking about 150,000 for the last, 9 years. And now it's like 2 million, 4 million, 6 million. We just accept that. We live in this crazy matrix reality right now.
Yeah, yeah. Well, I think to your point, I mean, it's like, I don't know that we've really, speaking in hindsight, I don't know that as a commercial real estate investor, we've really felt that impact just yet, right? I mean, this is a summation of your point is, everything's been riding steady because of the fiscal policy that's kind of been carrying people over, and you hear the reports.
And you're only a few months in.
You're only a few months in, right? So, and obviously we had a discussion with an economist on the podcast a couple of weeks ago, Elliot Eisenberg, and he alluded to, the government's going to be, their hands are forced. They're going to have to extend this fiscal policy. I mean, we're going to have to
absolutely 100%.
So we're still going to be able to ride this out, so to speak, if you will, without experiencing some devastating impact.
I hope so. Yeah. I mean, we'll talk about the black swans, but I'm absolutely in agreement with Elliot that the government has no choice at this point in time. They will extend stimulus. It doesn't matter what your politics are. We'll be able to ride this out. But while we're riding this out, if no black swan event occurs, and if unemployment benefits are still extended, NOI has still fallen.
Mm-hmm.
It's already fallen.
Mm-hmm.
So that price decline is already priced in, to kind of double up that quote.
All right, Neal. So let me ask the obvious question then, and you alluded to this again in the webinar, but should we be buying or should we be sitting back and waiting? What should our strategy be?
I don't think it's a bad strategy to buy right now, and I'll tell you why. So in February, right, you're buying a $20 million unit. The seller is forcing you to put in $100,000 on day one, sight unseen, hard money. And then within 30 days, you have to give them another $250,000. And then within another 30 days, you have to close, even though it's a huge purchase. Today, you have the same seller saying, no, come on in. I don't need any hard money. We take the 30 days and then we'll go hard on half the money. And, then you have another more time. And if you need, you can write in 2 extensions. So from that perspective, it's a better time to buy, mm-hmm. right, than it was in 2020. And also, when we're talking about outcomes, right, when you were buying in Feb, you were thinking you're going to exit in Feb 2025, right, 5 years ago. Away. In my mind, by printing $4 trillion and more to come, more stimulus to come, we've actually compressed cap rates 5 years out significantly, so that if you were underwriting a cap rate increase over 5 years, you don't need to do that now. The market will take a year to adjust to that. People were underwriting increase in cap rate. I don't think that they're going to be able to do that anymore, right? So it just doesn't make sense. Firstly, they won't be able to buy anything, so the whole market will adapt. And secondly, people realize that when you print money, it compresses cap rates. Well, we just printed the largest amount of money in the history of the world, right? So people know that that's going to compress in the future when the economy recovers. Not right now, obviously. So to me, if you think about it, so in 2025, you potentially have a better outcome from a cap rate perspective. You have an economy that everybody agrees has to be supported by politicians. And then on a post-COVID basis, once you find a vaccine, we find our footing back and our economy recovers faster. Why does it recover faster? Debt. I mean, we printed $4 trillion and put it into the economy, which helps it recover. Obviously, this is not free. Nothing in life is free. Our children are going to suffer for it because our debt to GDP ratio just went from 100 to 150. But because we are the reserve currency of the world, things are going to be okay for a while. And then the big reset, the debt jubilee that comes in the future, which probably was 10 to 15 years away, now is 5 years or 10 years away. Right? So obviously there's that challenge in the future that's going to stare us all in the face. But keeping that aside for a minute, we just made the conditions of your exit 5 years later better. We made them better. As long as your initial cash flow projections for your investors are more muted, and I can tell you today, you tell investors, I don't think my cash flow is going to be more than 6%, they're going to accept it. There's a lot of people that think that today investors haven't adjusted their expectations, and that's nonsense. There isn't a person on this planet. You could be living in an igloo in Siberia and still know about COVID. Everyone has been forced to adjust their expectations. So today, you adjust them for lower cash flow, and you can adjust them for a lower cap rate on exit. So you're going to make a bigger pop there, and you can still get close to your pre-COVID returns. Maybe your pre-COVID returns were 18% annualized. Maybe your IRR was 15. I think you can probably get to 14. Mm-hmm. So you have the ability to do that today. So the key question is, how are you going to answer the question that you will get from investors during any investor webinar you do today, which is, do you think prices will fall further? Well, now you have to say yes, because you've listened to me, right? Or you have to just say the mad scientist is just mad, so you don't listen to him. But if you're saying yes, then how do you answer that question? Why are you buying now? The straightforward answer is we're in it for 5 years. We think that this actually makes multifamily stronger. Need-based assets are going to be stronger than want-based assets like retail and hotel. That money, hundreds of billions of dollars, has to go somewhere. It's probably going to flow into our assets. We think cap rates are going to go down. That's the bet we're making. A lot of investors will accept it. They will accept it. What is their alternative? So can you buy today? Yes. Can you get equity today? Yes. Yeah. Am I doing that? No. but my point is, it is not outrageous to be buying today. It is not, simply because you have better buying conditions. There's a balance between sellers and buyers, and we still think that the asset 5 years out is going to be worth a lot more.
Mm-hmm. That's a great point, Neal. I appreciate you alluding to that, because, and this is a conversation that just internally, John and I have, not necessarily about sitting back and waiting. I mean, we're still obviously sourcing opportunities and such, but the underwriting practices have definitely changed and pivoted quite a bit just in the past 6 months. I mean, and every day as we learn from people like yourself, we're always constantly trying to implement those different changes into our underwriting, right, to see, but
I it's not going to change too much, and I'll tell you why. I just talked, Jillian, who was on that panel with me at the Best Ever conference. We've become friends since then, and so I invited her to my podcast, to my webinar, and then she invited me to the Realty Mogul podcast, and we were talking, and the truth is, both of us and many other people in the industry that are basically big, folks in the industry that are driving thought process, believe that the negative rent growth that we're going to see in the second half of this year and maybe Q1 next year is going to be flipped. And you're going to see very high rent growth, just like we did coming out of the last recession, where we had 6, 7, and even 8% rent growth in certain markets. So over a 5-year time frame, your projections of 2% annualized rent growth will still hold. It's just, you have negative rent growth in the first 9 months of your project, and then you have higher than 2% rent growth. So that might adjust out. If you're looking at 3% annualized rent growth, I think that may be excessive in this environment. So I think 2% annualized rent growth still holds over 5 years. I think you're going to get that. In fact, I think that you can do better than that. So it's down and up, but it evens out.
Yeah, that's a great point. I like that. I wanted to kind of go back to and ask you before we transition to another point is you have a great insight as to the forbearance, for both the tenant and landlords that have been applied here throughout this pandemic. And a lot of those forbearance incentives are, I guess, becoming due or they're starting to need to be addressed. How do you see that impacting the remainder, Q3, Q4 this year?
I think they're going to be extended. So let's talk first about single family and then about, commercial. On the single family side, there wasn't a huge wave of people asking for that forbearance. It was more than the multifamily side. People did ask for forbearance, but it wasn't massive. I think that Fannie and Freddie are, in the end, quasi-government organizations. So there's a lot of government pressure from them. I think that the single family piece is going to get extended, which I always believe is key. A healthy multifamily market needs a healthy single family market. You cannot have blood in the water on the single family side and expect to see the same cap rates on the multifamily side. So I'm hoping that they will extend forbearance on that side when it comes to loans, right? And that will help landlords like us. I mean, I hold a lot of single family rentals as well. So if I need to, I can then make use of that forbearance if my tenants are not paying me, right? And whether my tenants pay me or not, I don't know. That depends on how much government support there is coming in the next 6 months. I truly don't believe we need support in 2021. All the support that the economy needs is really in the next 5 to 6 months. The progress being made on the vaccine side and on the therapeutic side is phenomenal. I mean, that is the true success story. If there's one thing I can tell you is going better than we planned, it is the vaccine and the drug research. Those guys are flying. They're flying at much faster speeds than anything else. Government response, especially on the COVID side, has been awful. I mean, the US is unquestionably, over the next 20 years, going to be considered the worst response to COVID in the world. I mean, in the developed world. And anybody that doesn't agree to that is simply looking at this from a political perspective. Maybe they're Republican and they don't want to accept that. Doesn't matter. Maybe the Democrats would have screwed it up too. But the United States had the worst response to the pandemic. Anyone that looks at numbers, at infection rates, would come to that conclusion sooner or later. So there's going to be that story written. But on the vaccine side, on the therapeutic side, that's going to come out as a success story 2 years from now when books are being written. So bottom line is, I think support is needed for another 3 to 6 months before the good news starts to buoy everything upwards, and you need less support. We think that forbearance is going to get extended. We think that the government is coming to that same conclusion. We also think that it's going to get extended on the multifamily side. Now I'm going to break between multifamily and commercial here, because that's a different reality. So on the multifamily side, very few people have taken forbearance. So default rates in multifamily have just ticked up. They haven't gone up. They just ticked up a little bit. So if nobody's claiming forbearance, why wouldn't I extend it, right? There's no downside to extending something that people are not taking advantage of, right? So I do think that our forbearance gets extended, and we will have the ability to forbear our assets just in case our tenants stop paying us rents. But on the bad side, I'm pretty darn sure that the eviction piece is also going to get extended. These things go together. So if we get forbearance on one side, we're going to have to deal with a no eviction policy over the next 3 to 6 months. And some of it might be state by state, some of it might be federal mandates, but I do think that we will not be able to evict people come August. So I think August, September, October, I don't think we're going to be able to evict people, though some states will. I mean, Texas has been evicting people for weeks now, right? I mean, it's been about 6 or 8 weeks that they've been evicting people for. And then you've got other Republican states like Utah, which are like, no, we're going to evict people if they don't pay rent. So that's good. Some of these states will do it, but that's kind of the downside. Now, beyond multifamily, if you're looking at other asset classes on the forbearance side, I think that it's going to start getting really tight. I think that Fannie and Freddie are like, this is really bad. I mean, we've got a lot of retail assets. We can't give forbearance to people who are not going to pay rent. Nobody's going to pay rent, and Fannie and Freddie have their own, they got to pay interest. So I think that the retail and the hotel sector, they're going to start pulling back on forbearance, because you're going to see a huge amount of default in the retail and hotel sector. And a lot of people are like, yeah, but Neal, hotels came back. No. The hotel market can't make money at 40%. I mean, they're just losing less money. But if they lost a lot of money in a quarter and their balance sheet is negative, which means they have no money in the bank, the fact that they're now losing less money is not relevant. They still can't pay their mortgage, right? So you're going to see a lot more blood in the water in hotels in Q3 and Q4, even if that 50% goes up to 55 and then 60. Simply because they're running out of cash balances, they're running out of reserves. And it takes a while to run out of reserves, right? I mean, you haven't seen Royal Caribbean go bankrupt, you haven't seen Carnival go bankrupt, because they're running on reserves. But eventually everybody runs out, right? So I think that sector of the market, you're going to start seeing a bloodbath. A lot of the focus, the articles will turn from multifamily to commercial as that bloodbath starts to explode in the coming months.
Yeah, wow.
So do you believe that wave of investors turning their head away from those sectors bolsters multifamily as well?
It's going to be short term, because, I mean, there's also going to be investors like me looking at those sectors that I've never looked at hotels before, I've never looked at retail, but now I'm like, fire sale, right? So I think it's both ways, right? So there's going to be a bunch of people who are like, you know what, I thought this sector was the same thing as multifamily, and now I realize it's not. Multifamily is a need-based asset class. This is a want-based. So there's going to be a flood of money out of it, but it's going to take a while for the money to get out, because it's trapped. Nobody can sell a hotel asset today. Nobody can sell a retail asset today. They have to wait for bankruptcy. They have to wait for default. So it takes a while for that money to come in. But in the long term, I think, yes, there's an adjustment where people are like, multifamily is not the same as commercial. There's a big difference, and it's a better asset class, right? And true, we are also supported by government policy. Point is, we're supported by government policy. I want to be in an asset class that always gets supported by government policy. The government basically didn't bail out the hotels. The government didn't bail out retail, right? Retail didn't get that money. The money went into rent. All the money came in from the government. It went to food. It went to rent. There was nothing left over for retail. And so there was a bloodbath there. That is not something that investors are going to forget. That is why, and I'm known as a mad scientist, I predict lower cap rates in multifamily 3 years out. Everyone that's predicting high cap rates is wrong. Firstly, because they don't understand the impact of this $4 trillion that we just injected. And secondly, everyone just realized that multifamily is a better asset class than commercial. Those two things don't change when COVID goes away, right? Mm-hmm. So I'm projecting lower cap rates and higher prices for multifamily in the future. But there's going to come a time when it's going to make sense to go back into hotels. I mean, if their cap rates, which are definitely going to go up, if they adjust from 6 to 8, then, I mean, they're a very high cash flowing asset. Hotels especially are a cash flowing asset. They often produce 12, 13% cash flow, which we can't produce in multifamily. So at some cap rate, there's going to be a balance. So the way I see it is a lot of people that have currently invested into hotels, bad for them. Mm-hmm. But the guys that buy the hotels from them, the guys that buy the retail from them, good for them.
Yeah, yeah. I mean, it's always unfortunate when you have these type of circumstances in these downturns, but this is where opportunities lie for the savvy, prudent investor, right?
You can always make more money that way. And I'm not so sure about the future of retail, but because retail and hotels are different. I think hotels have a bright future, right? It's just they're going to have a really tough time in the next 18 months, okay? Or if there's another pandemic, we'll have the same problem. But retail, pardon my French, is totally fucked. I mean, because what we did over the last 4 months was we trained hundreds of millions of Americans. We trained them on what John's doing, right? He's waving his phone. I mean, I used DoorDash 3 times in the last 3 years. I've now been using it twice a week since March, right? And I am a tech guy. I'm a tech savvy guy. So that was a new vertical that opened up in my life because I simply wasn't paying attention to it before, right? I'm now ordering 3x the stuff on Amazon that I used to order in Feb. Mm-hmm. E-commerce usually grows at 10 to 15%. The US economy grows at 2%, so e-commerce grows 5 to 10 times faster, right? Which is already phenomenal. Did you know that e-commerce grew from last July to this June? E-commerce grew at 77%. Whoa. That is 40 times the speed of the US economy, right? 40 times. Now, currently, US economy is 0, so it's infinite number of times. But in general times, that's 40x, right? That's a one-way street. That is not going to go back. A lot of people are like, no, as soon as the pandemic's over, we're going to go back to this. No, you're not, because when people learn new ways of doing something and they realize that it's much more efficient and much more convenient to buy stuff on the internet, then they don't walk away from that because you're going from convenient to less convenient. Mm-hmm. I mean, we're a convenience-based culture. We've now figured out that it's so much easier for me to pick up my iPad, tap 4 times, and get stuff delivered. Yeah. Right? And that was always the case, which is why e-commerce was already growing at 7 times the pace of the economy. But there were holdouts. 100+ million Americans were holdouts. That's gone. So in my mind, half of retail in the United States just goes away. And some of it is going to pivot. Some will become multifamily. Some will become something else. Some will become industrial. But it just is going to go away in the next 2 or 3 years. So different outlook for hotels versus retail.
Yeah, that's a good point. And speaking of that, there appears is that there's going to be a lot of opportunity in the industrial warehouse space, maybe, right? Because as you mentioned, as e-commerce continues to grow, there's going to be a higher need for distribution centers and warehouse type of
absolutely. I mean, and there's like so many pieces to that. There's so many reasons. So firstly, in Feb 2020, pre-COVID, the #1 ranked real estate class in the US was industrial. Mm-hmm. It wasn't multifamily. It wasn't self-storage. It was industrial. Why? Remember the whole thing about pre-COVID, e-commerce was growing at 15% and the US economy was growing at 2%. So when you have something that directly benefits from e-commerce, like industrial does, obviously warehousing and logistics benefit from e-commerce, right? Because instead of putting something into a big box store, you're driving it around in trucks, but now you're storing it in cheap places like warehouses, right? Retail is about $4 a square foot. Warehouses are 70 cents a square foot, right? Mm-hmm. So now you're storing them there and moving them when a consumer orders. You're just moving them the last mile, right? Mm-hmm. So already it made all the sense in the world to invest in industrial. But now we've gotten 6 years of e-commerce growth in 4.5 months. How could we possibly have enough warehousing? We didn't build any in the last 4 months, right? So in my mind, that is absolutely going to happen. But then there's a second piece to this. The US is known as the world's best just-in-time or JIT economy. We only have 4 days of food. We only have 4 days of toilet paper. We only have 4 days of Purell. Well, that can't obviously work anymore. We need to basically switch to a 5, 10, 15 day. So there's going to be some new equilibrium there where the US is not going to be a 4-day economy. It's going to be a 5-day, 10-day, 15-day economy. We'll learn from this pandemic. Well, doesn't that need billions of dollars, billions of square feet of storage? And then you've got the third concept, which may be the most powerful of them all, which is that everyone that I know of that is in politics is screaming, we need our supply chain to be local. We cannot depend on China for masks. We cannot depend on Vietnam for our Purell. We need the supply chain to be local. We need to figure out how to do that. So now you're going to have a slew of bills that is going to pass at the state level, federal level, city level, saying we need local supply chains. Well, you never built the local supply chains. Now you have to build them from scratch, right? That might be the biggest one of them all if we want our supply chains, because what we're doing is we're taking billions of square feet of warehouse space in China and turning it into billions of square feet of warehouse space in the US. It doesn't take any less space to store stuff in the US, right? So, right, it isn't any cheaper, but we're doing it because people are like, we can't let our supply chain be hurt like that again. Right? I mean, so think about all of the things that come out of this. I mean, every single profession, especially healthcare, is going to then say, we need to store more. We cannot possibly do what we did before. And healthcare is such a big part of our economy. 17% of the US economy is healthcare, that if they decide to store 50% more stuff, we better build some big box warehouses in every single part of this country. So, I mean, far and away, the biggest winner is industrial.
Man,
we just got a master class, Cody.
We sure did.
Fantastic. I mean, I'm going to re-listen to this episode. We've had a lot of great insight from you, Neal. This is
thank you.
Things to ponder across the asset class, because we get focused in our vertical, right? But we've got to broaden our aperture and having the perspective on, well, each one of these asset classes is a little bit different. It's not just commercial real estate. It's just not just income producing properties.
Right.
These are all different, and they have different drivers behind them, and you need to understand those things.
Yeah. I think understanding that big picture really helps us as we kind of decide what verticals to go into, when to build, when to buy, what to build, different asset classes. I mean, we were pivoting to industrial before. I mean, our industrial pivot, even though we came out with our first industrial project yesterday was our first webinar, was obviously pre-COVID, because we've been working on this asset for a long time. We just felt like there's no way back from e-commerce.
Agreed.
It's a one-way street.
Yep.
Yeah, totally agree. Well, Neal, man, we had a couple other topics we wanted to cover with you, but we're obviously getting
next time.
Yeah, man, we're getting near the end of our time, unfortunately. But man, we'd love to have you back on the show and pick your brains some more. I mean, this has just been phenomenal, tons of information. So you definitely have lived up to the mad scientist name for sure. So we appreciate that.
Thank you. And thanks for having me on the show. It's always fun to basically get into this kind of free form format, right? It's so much more enjoyable than the PowerPoint deck stuff.
Yeah, man. Yeah, it's great. It's awesome to have the pleasure to speak with you on this forum as well, man. So great to get connected. Got a couple more questions for you, if you don't mind, before we wrap up, and then we'll call it a day. So,
sure.
So obviously you're very big into following data. You're very big into, research and what's going on in the marketplace. What else do you like to do for your continued education?
I think that's a hard question, because I think all of my time gets taken up just following the data. Every once in a while, I like to kind of disconnect and go do something completely different that I have no knowledge of. And my university for doing those things is YouTube. So, right now I'm building from scratch, stuff in my house that I haven't done before. And it's forcing me to really think about that. I mean, it's just the math of some of the things that I'm doing is so complex that it's forcing me to completely come up with new learning, right? Because the problem is because I follow data so closely, it's not new learning for me, right? So I think every once in a while, we've got to go out and do stuff that is just completely counterintuitive, because that's a million times more beneficial than just repeating the same stuff we do.
I like that. That's such a good point. That's such
Hiring
a good
new
point.
synapses.
Yeah.
Yes.
Absolutely.
Firing new synapses. There you go.
Absolutely. John's got all kinds of good stuff, man.
I know.
I'm just the one-liner.
Neal, what's been some of the biggest like lasting lessons that you kind of learned along your journey as a real estate investor?
So as a real estate syndicator, right, somebody that takes other people's money, I think the big lesson I've learned is don't get into markets based on what could happen to them in the future. Because we tend to sell ourselves and our investors on this huge vision of the future. And what I've seen is sometimes that vision just doesn't take place. So go into markets that already have a lot of wind on their back, not markets that don't. And be careful there, because you'll find good news about every market in the US. The worst market in the US probably right now is, Shreveport, Louisiana. I bet you I can find 10 good articles about Shreveport, Louisiana in 20 minutes. It doesn't change the fact that it has horrible unemployment and a GDP that's dropping. So don't fool yourself, because when you do that, you are an unpaid wage slave. You sell your investors on it. That's the worst thing that can happen, because you trap their money in there, but you also trap yourself in there, because the project's not going to make any money. You're going to hate your monthly write-ups to investors, your quarterly webinars. You're going to hate yourself for doing that, because it's like, oh my God, I don't want to really look at this awful project anymore. So don't sell yourself on a project for the sake of acquisition fees, because then you're a unpaid wage slave for 5 years. That's my message. I've already done that. It's been horrible.
Wow. Well, great tip. Great point. Great point. Any advice that you'd give to the listeners to help them grow their business?
I'm going to put in a shameful plug. I think that one of the best places on the internet to learn more about these kinds of asset classes and what they're doing is Multifamily University. We host about 40 webinars a year. More than 75,000 people sign up for these webinars. We always have 500 people in the room, so everyone's like, but there's only 500 people in the room. Well, our Zoom license is 500, but anyone that doesn't get in, we post it on Facebook Live, and there's hundreds of people watching there. But that, I think, is a great way to learn. I find that this kind of a podcast town hall structure is very convenient to learn. So apart from podcasts, I also suggest that you check out Multifamily University, which is multifamilyu.com. I think most of our last 20 webinars are either on the website or on our YouTube channel.
Yeah, I concur with that. Neal, this is Multifamily U has got fantastic content. So folks, this is not, this is certainly a plug for Neal, but this is great content. And I've seen a lot of content on the internet around multifamily stuff, but this has been amazing.
Yeah. Hands down.
Thank you.
Hands down. So, all right, Neal, tell listeners how they can get connected with you and learn more about you aside from Multifamily U.
Well, it's really simple. I'm very blessed and very cursed in that I'm the only Neal Bawa on the internet. So if you type in the words Neal, Neal, and Bawa and hit enter, you're going to be able to connect with me in about 24 different ways.
Awesome. Neal, great conversation, man. Appreciate all the wisdom and just a ton of just information shared. And man, we look forward to continue to follow you and learn from you. And so appreciate everything that you're doing for us as fellow investors. So
sounds good. Thanks for having me on the show.
Thank you.
Thank you.